Well, interest rates are not having a good 30-day period, folks. We are seeing interest rates higher again today. We're going to dive right into the numbers and we're going to talk about what's moving the market. So here we go. Mortgage News Daily has the average for a 30-year fixed rate conforming at 7.52 today. Y'all, we were at 7.43% a week ago today. We were at 6.92% a month ago. So we are up 0.6 of a point, almost 5/8 of a point in a 30-day period. You have to go back to November of 2023 to find rates as high as they are today. So that's not the right trend, y'all. It's not what we wanted to see. And it's because the last several reads on inflation, as we have discussed on previous videos, has just been disappointingly high. It's going the wrong direction. You know, we're nowhere near the highs that we saw 2 years ago, but we are not anywhere near the levels that we believe the Fed is going to be more accommodative with their monetary decisions. So, you know, that's the situation that we are stuck in. And we got some distressing news today on two fronts. And they play into each other in a very unfortunate way. The first is first quarter gross domestic product came in far lower than expected, came in at 1.6% versus the 2.5% that had been forecast. Ordinarily, by itself, that would have given some support to the notion that the Fed could go ahead and start cutting rates. That's an indication that the economy is slowing down. It's an indication that folks are spending less money. Here's why the market is not interpreting it that way. We had the personal consumption expenditure reading for the first quarter of this year was up 3.4%. Y'all, the Q4 reading of last year was 1.8%. So we've nearly doubled the rate of inflation as measured by the PCE quarter over quarter. And that is a significant problem when you have spending pulling back. There's a name for that economically. It's called stagflation. When you have spending slowing and inflation continuing to increase, that's called stagflation, and it is a very challenging thing for the markets to get out of because there's really only one place to look for the cure to that, right? We can either, you would hope that we could slowly grow out of it, but the stimulus that's causing this is the amount of dollars that are in the economy being printed to support the massive amount of debt that we have accumulated by our federal government. Y'all, we are just spending way too much money and we are not taking in the revenue to offset those expenditures. That additional debt that has to be floated in order to finance that debt is just a massive amount of additional debt instruments on the marketplace. That draws the price of those instruments down. The yield moves inverse to those prices. That is our interest rates. It's why we're seeing stubborn inflation in the face of spending pulling back at the consumer level. Government's got to get this handled, folks. I mean, this is an area where I'm going to become a little more vocal in my advocacy. You need to be looking for candidates that are talking about fiscal responsibility. Our federal government has got to get their act together when it comes to spending because this is not sustainable. When we start moving into stagflation, that is directly laid at the feet of policymakers in Washington, D.C., and it needs to be something that's taken into account as we get nearer to an election. Y'all be looking for folks that are fiscally responsible and talking about balanced budgets because that is the only way that we're going to get out of this in any kind of time frame that would be suitable for all of us. Probably more political than anyone would like for me to get on this call, but that's just the way it is, y'all. These are policy decisions that are affecting where we are. These things didn't happen on accident, the situation that we're in now. The Dow was down as much as 600 points today on these two reports. I think it is going to finish the day down 300 plus. Mortgage-backed securities are likewise selling off, which means that folks are just simply pulling money out of the market in cash. They don't have a place to put it right now except for gold. Gold's up nearly 30% over the last 6 months. It's one of the few things that does well in an environment like the one we're in. So y'all, this is a lot to keep an eye on. I am frustrated with policymakers that have taken us to this point. I hope everyone is. So this is probably not the last time I'm going to be a little more openly political on this call. But that is the solution, y'all. We got to spend less money than we take in. That's the bottom line. In any event, I hope this information is helpful for you and for your clients. Hopefully I will have some better news to report next week, and we will talk to you then. Stay blessed, stay safe.